well done everyone for making it to a 9 a.m. session on the last day of conference. It's much appreciated. And I'm delighted to have this panel here today to talk about a really, really important issue and one that has had a lot of airtime this week over the course of African Energy Week. So what I want to do is I want to start off by asking each of the panelists to very briefly introduce themselves and then also comment on the crux of the issue that we want to discuss today. And that is around Africa's risk premium and whether or not that is something that is real, is it perceived, what is the world view on this? And actually, what can organizations operating or looking to operate in Africa do in order to get investors more comfortable with the situation on ground? So by way of introduction, my name is Tim and I work with Control Risks. I've been based in Lagos, Nigeria for the last 12 years or so, and we provide a lot of advisory support to organizations looking to invest. So inbound investment is a subject very, very close to my heart. A lot of that is in the oil and gas and extractive space. But I'm going to put that question first of all to Samira. Come to you, a brief introduction and then a comment. Is this a perceived issue? Is this an actual issue? And what do we need to be doing about it?
Yes, no, thank you very much, Tim. Good morning, everyone. I'm really excited to be here. It's my first edition of the Africa Energy Week, and I must say that thus far I've been impressed. I'm part of the S&P Global family. We are co-sponsoring the event. I'm on the racing side of the business, and I head the African franchise for S&P. I'm based in Johannesburg. So we are one of the few, global rating agencies that has foot on the ground essentially. So a physical presence on the continent. We are opening an office actually soon enough elsewhere on the continent in Nigeria. And so that speaks to our long-term commitment to the development of credit markets. And the question that you put forward, Tim, here it's an extremely important question. We don't take it lightly. I've been speaking about this the whole year and the years prior. Because yes, the risk premium has knock-on effects, of course, on particularly, on sovereigns' ability to essentially carve out financial flexibility to invest in infrastructure development, which is something that we certainly lack on the continent. So the risk premium, it's a question, at what level you go to market to essentially raise capital to then do what you have to do in order to develop and meet your SDGs. When it comes to global credit ratings, these are essentially a relative ranking or probability of default of a corporate, a sovereign, to meet their obligations in time, on time, and in full. So they are certainly underpinned by facts, data, and so we trade really extremely carefully. Uh, we are what we call credit fundamentalists. We do credit analysis. We don't do guesswork. We travel across the continent. I've done so far just this year 20 countries out of 55. And trust me, it's not easy to travel across the continent, and I've been doing that for a lifetime. uh, be- because I have a few miles under the belt. So credit markets and credit ratings serve the purpose of issuers who needs actually to raise money. And of course, investors who essentially need to price the capital that they are lending to issuers, be it sovereign or corporates. And so these credit ratings are based on something that is quite important and speaks to data. And this is something that we are not paying attention enough, I suppose, across the board. Data consistency, data system is something that we need to pay attention to, particularly when it comes to issuers, sovereigns, and corporates. And especially in these days and age where you have, of course, the emergence of AI, that data integrity, the control of the data, which essentially underpins the credit story that you want to put forward to investors, is absolutely key to that, and also enables essentially a more effective policy making. When you have 40%, 50%, sometimes even 70% of your GDP that is not accounted for, and you fall short on government revenues, then yes, it could be a problem for sovereigns to essentially really effectively implement policy and reforms across the board. And perhaps I will leave you with that third point that I have in mind, and we don't talk about it enough, I think, or perhaps not in the right way, and it speaks to institutional strength. It's not about governance, it's not about politics, absolutely not. We don't rate to, which political party comes into power, for instance, when it comes to sovereign ratings. We will actually look at whether or not you have a track record that doesn't lie. It's not something soft, a track record of effective policy implementation that trickles down to the private sector and translates into economic growth, headline economic growth, job creation, and trickles down to other sector. If let's say you take a country that is commodity driven, for instance, or hydrocarbon driven, this is what we are looking at. So institutional strength, not only at macro level, so country, but also on project. And this commodity project, these large oil and gas assets, they also need to be managed in a way that institutional strength is preserved.
Yeah, absolutely, and I would concur with all of that. I'm going to come back to you in a bit to talk a little bit about the African Credit Rating Agency. But before that, Franklin, keen to come to you. So a brief introduction from your side, but then also just your thoughts coming from the financial services sector. What do you see as being the risk premium? How real do you see that versus the perception? We're keen to get your thoughts.
Thank you, Tim. Good morning, everyone. I'm based in Riyadh, Saudi Arabia, and I work for Credit Suisse, working with the local stock exchange called Tadao, if any of you know about that. Before I move on, I want to thank the organizers of this event. It's getting better year on year as I hear. Just like Samira is my first out of many, hopefully to be here, to be able to participate to the development of this objective. So to your question about perceived versus actual, I think it's both. I think as Samira has elaborated, there is data behind the risk premium, but everywhere, not just in Africa, risk premium is about perception, right? Now you separate that with the, let's say, psychological effects of halo effect versus stigma. Africa suffers from stigma effect, right? Stigma being the sort of perception of stability coming from political stability. We've had conflict in the past. So all of that fits into the perception of the risk premium. So I won't talk about the sort of actual. I would focus on the perceived side of it because there's a cost to it. Having extra additional basis point on the risk premium translates to tens to hundreds of millions when you look at the scale of the infrastructure projects in the continent. And what that means, if you put actual cost to it, is money is taken away from other aspects of economic development, jobs are sacrificed. What we are here for the last 3 to 4 days, energy security is sacrificed. So the cost is not only opportunity cost, it's generational cost, right? So this makes this the most important topic we could be talking about at this conference. Because if Africa doesn't solve the perception side of the risk premium, we continue to suffer. That impacts, that replicates down to so many other sectors because energy and infrastructure is the driver for our economic growth, right? So what do we do about it? Before that, why is it so? What Why is the data, if I can point to the studies made by Moody's, right, on the rate of loss.
I can't speak to that.
I know. But well, I have to say it for the audience. So the rate of loss comparison between Africa projects and Central America and Central Europe, it's a big difference. Africa being on the lower side, right? Why does that not translate to the risk premium? Why is there a disconnect? So it will come back to the point I want to touch on behavioral finance, right? If I have to talk about behavioral finance, you cannot avoid biases. And those biases have to be catered for, right? How do you approach that? Data, education. On the data side, you look at the analysis from a project performance perspective. So the whole traditional model is about country risk, and then you move down from there. But maybe that is not the solution for Africa. Look at the project performance, build the data from there, right? On both sides, on the sovereigns, the national oil companies or national institutions, and the investor side. The education is supremely important because at the end of the day, we're talking about perception, right? Perception is countered by education. So this is the education on the global stage that the African sovereigns, regional institutions are making positive drive towards addressing this. I mean, just the awareness of that perception that there is a concerted effort in the continent to address this helps to alleviate the perception, right? Education also on the actors which we have talking to the global markets. So at the end of the day, at the back of these risk committees, at the back of these investment committees are people just like you and me. People come with biases, right? So you have to address that. Our messengers we send out there have to be speaking the language of the investors, of the investment community. So sometimes I've been to a panel where the idea put forward was we need finance, and then it stops there. But that's not enough. We need finance. It's just like going, I need money, right? What is it in it for me? What is the language that I understand? What is your project performance? What are the measures that not just one country, not just Angola or Mozambique is taking? What are the measures that the entire continent is taking, right? Because believe it or not, I would love to treat Africa as individual countries, which they are, with their specific diversity. But the perception, again, the biases are, or the continent as one, right? So the continent needs to be seen as addressing this perception issue. Thank you.
Yeah, I think some really interesting points there, and particularly one that resonated with me was your initial comment about the human impact of this, of not having access to capital, of being starved of capital, and the very real impact that has at a ground level, which sometimes in our lives of risk assessments and macroeconomic modelling can get lost. So I think that's a really, really important point to make. Vianney, I'll come to you next. A brief introduction, and then your thoughts coming from the oil and gas trading side. How do you see the risk premium in Africa? Is this something that is real? Is it genuine, or is this more a perception issue, or somewhere in the middle for you?
Sure. Thanks, Tim. Good morning, everyone. So I'm Vianney Faucheur de Battisti. Very happy to be back here again this year. I'm part of TotalEnergies Trading. I sit in Geneva. Just to give you a brief overview, TotalEnergies Trading trades around 7 million barrels per day, crude oil and refined product. We do have another trading division, two other trading divisions for gas, renewable, and electricity. Within this organization, I focus more on providing structured solution to our customers, offtake, embedding financing solutions. I would say that I'm going to be shorter than my colleagues, my fellow panels. I would say that African risk premium is often more in our business more about perception than real risk. Yes, there are some risk in Africa, but they are not so different from other frontier markets. really the reality is that whether all the improvements that have been made over the past year have translated into better credit terms. And if this is not the case, why is it so? So that there is a new shape of liquidity in the market today, a new trend, and I guess it's of importance for borrowers to try to focus on really innovative financing structures and try to tap those new liquidity providers. And I think we'll discuss a bit more later in the panel who are those new liquidity providers.
Absolutely, yeah, thank you. Gabby, I'll come to you. We have a shared background in risk advisory. Really keen to get your thoughts on the Africa Risk Premium after a brief introduction.
Sure. Thanks, Tim. Firstly, thank you for hosting this panel. It's a pleasure to participate in it. My name is Gabby Reid. I am head of advisory at Pangea-Risk. We are a country risk analysis firm, specifically trying to bridge that gap between the credit analysis and perhaps the context that Franklin was speaking about. In true consulting fashion, I'm going to say we see it as both as well. It's not fence sitting, but I think that there's a few points we can speak to today that really shape why the risk premium is shaped as much by perception as it is by actual fundamentals. So I think the critique of the methodology specifically that credit rating agencies use is specifically that it's rigid, it's opaque, it's perhaps ill-suited to the African environment. And you can look at certain data points that would support this argument. So Franklin, you mentioned the loss rate specifically on infrastructure investment that Moody's published. And I've got the numbers here just for context for the audience. On that finding over a 14-year period, Africa's loss rate was at about 1.7%, but if you compared it to Latin America or Eastern Europe over that same period, you were looking at 13% and 10% respectively. So points like that certainly drive the sense that the fundamentals are painting a different picture to what the risk rating is. But having said that, structural weaknesses still persist on the continent. And I think it's important to take note of these because this is what contributes to the perception of risk. So issues around fiscal transparency is really important. Issues around political stability is really important. And overall, that speaks to the predictability of an investment climate, which is what investors are seeking. So again, let's look at some data points. If we look at the period between 2000 and 2022, there were 123 violent regime changes or substantial regime changes on the continent. Now, the reasons for that will be very varied, and Africa is not a country. Every country will have a unique reason as to why that took place. But what does that do? It adds to the perception of instability, unpredictability, and that adds to the perception of risk. But I would actually say, so if we land on it, it's both. It's real and it's perception. I would actually look to take it a step further. What is actually at the heart of this debate is the purpose, or what problem are we trying to solve for? Global rating methodologies are designed for cross-market comparisons. It's so when you're looking at an African market or an Asian market or a Latin American market for investment, you can compare apples to apples. That solves the problem of comparison, but it does very little to address the impact of Africa's uniquely high borrowing costs. On average, African corporates, African sovereigns borrow at a rate 4 to 8 times higher than their advanced economy counterparts. And this is going to have an impact. The UNDP stated that more or better aligned ratings would result in around 75 billion US dollars in savings annually for the continent. That is finance that can be driven into infrastructure, human capital investment. So it's really not around, we shouldn't abandon the comparison model, but it really is around better capturing African fundamentals. So we need evidence-based ratings that are supported by transparent data that's provided by African sovereigns. Africa needs greater agency in shaping the narrative of that perception, and then structuring of transactions that have measurable and real impact. I think that will go a long way in building credibility, building confidence in longer term macroeconomic planning that we're seeing on the continent.
Thank you. And I'll certainly come back to you on the political stability points in due course. But Samira, perhaps if I give you an opportunity to respond to some of that, because there was quite a lot of
Yes.
discussion there, which very much touches on your part of the world. But also, if I could ask you for a comment on the soon-to-be Africa Credit Rating Agency, which I believe we're looking at sort of middle of next year in terms of operational establishment. What do you see there in terms of being able to fill some of the information gaps or help generate a better sense of confidence
Yes.
for the continent?
No, thank you, Tim. And I think my co-panelists have said quite a lot. So let me try to break it down and bring it home here. So the African Credit Rating Agency, so I understand it will be headquartered in Mauritius. Listening to the deliberation last week, I think it was at the UNGA. It's a good thing. Look, we welcome the creation of the African Rating Agency. It is not a problem at all. I think investors need as much information as possible. And if the AFCRA is meant to essentially provide more granularity or a different angle to investors to invest across the continent, then yes, we really believe fundamentally that it's a good thing. We don't know much essentially about the model, about the rating approach to rating sovereigns, for instance. I think that would be their primary focus, but they will probably do other ratings. So I can't comment much more than that, to be honest. And we are not in the habit, nor the business actually, to comment on what other rating agencies do. I think investors are certainly discernible enough, sophisticated enough, and knowledgeable enough to make a difference, between a credit rating coming from S&P Global Ratings versus another agency, and it's all fair and well. Now, these rating essentially not only serve, like I said, the issuers, the sovereigns and corporate who needs to raise funding, but also investors. Where is the money? The money is sitting in North America and Europe and some parts of Asia. To be able to allocate funding and capital across projects, these investors, they need global credit benchmarks. They can't have something that is different for let's say, Bangladesh, or because it's somewhere in Africa, let's say South Africa, for instance. They need to be able to say, okay, if I want to allocate 500 million, and they generally scale up actually their investments. They don't like to invest in small chunks or tranches. They certainly need to know that they can essentially rely on a benchmark that is comparing a country on the same basis. Not thinking, oh no, because this is in Africa, then probably the rating agency has treated that differently. No, we don't treat that differently. The rating approaches are certainly public. Everybody can essentially go onto our website, look at the methodology. What you will be missing from reproducing a credit rating that we do is essentially the peer comparison, the data that is important not only for us as a rating agency, but also for any stakeholder. But other than that, you have that possibility to absolutely understand what we are looking at. And when the data is missing, the criteria is very clear, saying, okay, we essentially, take a view on some ratios. The context is there because we speak to stakeholders, we speak to clients as well, and we will notch up or down for different data points that are, overstating or understating a specific risk factor. So there is nothing secretive about it. There is transparency. We make a tremendous effort, certainly, to break it down and to educate the market about what we do. So global credit benchmarks are here to essentially attract global money global capital into the markets. We provide foreign currency ratings and local currency rating. So when sovereigns, for instance, need to raise a Eurobond or US dollar funding, they would typically invest and need a foreign currency global scale rating. Now, to attract portfolio flows like South Africa does, because we have a fairly comprehensive ecosystem here. It exists also in Nigeria. It's not the only country in Africa where we have like a true ecosystem. We still need a global scale local currency to be able to attract portfolio flows into the domestic markets. Now, we also provide national ratings, so local scale ratings, which speaks to domestic specificities in any given country. And these are not comparable across countries. So every rating has a purpose, and the purpose is to raise capital, is to mobilize capital in order to meet the SDGs and economic development for the benefit of everyone.
Very good, very good. Franklin, I'll come back to you. You spoke very compellingly about the imperative, the need to get capital into Africa, into the energy markets here. Could you share some thoughts on what are some of the alternative sources of financing that organizations can look to if they're not getting the terms that they think they should be getting? You mentioned around the sort of looking at things on a project by project basis. Could you just share some more thoughts on that, please?
So that's a thank you, Tim. That's a very very important question. If I go back to one of my professors at Columbia University, he said, you cannot solve for a problem if you can't quantify that problem, right? So what are we solving for in terms of financing in Africa? If I go very recently to the figures, let's say the OPEC figures of what is needed for the next 5 years, globally for investment, the 700 billion annually, I'm sure you're conversant of that. And if we now overlay that over Africa, Africa has got somewhere around 20% of untapped hydrocarbons, right? So let's take 20% of 700 billion. So we're talking about 140 billion, right? That is a quantifiable thing. Now, if we have the perception issue, we have the sort of difficulty in the global markets, then we have to come closer to looking within. What are the instruments? What are the facilities we have in the continent? I was part of one panel where this Indian chap said, India built its infrastructure by itself, right? That is impactful. Africa can build African infrastructure with African financing. What does that entail? We have to be innovative. We have to look to new technologies, tokenization, cryptocurrency. Africa in the last year, investment value in cryptocurrency, 205 billion. Rate that against your problem quantity, 140 billion, right? You begin to see how figures stack up. Remittances, 100 billion. Why can we not crowdfinance to Africans themselves, right? Now, the really, really important point is sovereign wealth funds. Because what we are here discussing is about long-term economic prosperity, long-term energy security. Who is more long-term focused than Africans themselves, than African governments? Now, the sovereign picture is a nascent one, right? If we put figures to it, let's say Asia has got 9 trillion of combined SWF assets. Africa has 300 billion. There's a big gap, right? So even if I discount off Saudi Arabia, UAE, China, we're still looking at 5 trillion of sovereign assets coming from the Asian tigers, the exporting nations. We are 300 billion. Can we up that? Yes, we have the resources. So we can build sovereign funds. I heard recently about Ghana's Heritage Fund. In a short time, they've accumulated $1 billion. Now, imagine that collectively. We have sovereign funds up to 1 trillion. We can self-finance this infrastructure development. We can write our story. One other last thing to mention is the maturity alignment. So a global investor would be looking at maybe 5 to 10 years. We are looking at 20 to 30 years. A sovereign fund with that capability would align in maturity. So the story can be told differently. We will not be talking about perception because we're doing it ourselves. So in terms of alternatives, there are other financial market instruments. Brazil was very successful in local currency, long duration bonds, which is very attractive to pension funds as well. But the picture is there is so much more we can do. There's so much more capability as Africans we have to finance our infrastructure, our economic development. So it's a wide topic. It needs a panel on its own.
I really appreciate your thoughts on that, and yeah, some very interesting comments there. I mean, development by Bitcoin. You heard it here first. So, Vianney, I'm going to come to you on a closely related topic, and that is you mentioned some of the issues around the terms of lending that we experience on the continent here, which is a source of frustration. What can be done to differentiate and secure better lending terms, and what are some of those other alternative sources of finance in addition to what Franklin's covered there?
Sure. I guess, I mean, to step back a bit, what we witnessed over the past years, like the liquidity landscape has dramatically changed in Africa. In the past, international commercial banks were kind of fueling the African energy project, which is not the case anymore today. There are some opportunities. There are some new liquidity providers, like mainly the DFIs, the Afrexim, the Africa Finance Corporation, that are here to support the project. So it's very important for project developer to make sure that the project aligns with the requirements from those DFIs in order to attract those liquidity. Another way to kind of get access to funds is to mitigate the political risk and use insurance cover such as MIGA, or Afrexim set up their own insurance company called Faucheur, if I'm correct. So I think it's very positive for the African market to see this kind of initiative where the insurance company were kind of dominated by the Lloyd's market, and the market was kind of saturated over the past years on certain names. So that gives a bit of fresh air for investors. It's pretty important to build local partnership. That's of utmost importance. And I would say as well, in the past, investor bankers were going to create committee without looking at the ESG and the climate goals, which is now kind of the first step in every single project. If you not prepare a clear strategy on ESG and climate goals, you won't be able to, to cross any gate on credit committees. So on top of the DFIs and the more traditional liquidity, we see new players coming into play, such as traders. Traders in the past were kind of filling the gap in the capital structure for project. Today, they are really leading financing structures and bring alongside them new liquidity players, such as asset managers, private credit funds, in some cases, family offices. And again, there is a bit of education here, but this provides to well-managed project the liquidity it needs. And I mean, last but not the least, without stating the obvious, I would say that it's very important for a project developer to show strong preparation, meaning having good feasibility studies, relying on reliable, independent advisor, reputable law firms, will make deals bankable. So I mean, in summary, better lending terms are not just about negotiation; they're about strategic alignment. And with the right structure, the right partnership, and the right risk mitigation, African energy project can attract the capital they need.
Excellent, thank you. So, Gabby, I'm going to come to you for the final word, and I guess a question in two parts. We've spoken today about the bias, the perception, some of these challenges. One of the things that crops up a lot in investor meetings that we have is around the sort of worst case scenarios, things like resource nationalization or appropriation of assets, which unfortunately appears to be back in fashion in West Africa, which is very close to home for me. Can you talk a little bit about that, about what organizations can do to protect themselves from that, but also to instill more confidence in investors around some of those, I'm not going to call them black swan events because they are predictable to a degree, but some of those more dramatic events. And then secondly, and related to that, Samira commented on the importance of political stability and the regulatory environment and sort of getting beyond what's happening from a policy perspective. Could you comment on how important that is and what you see the opportunity there for attracting investment is?
Sure. Absolutely. I think, resource nationalism is not exactly new for the continent, but it's definitely playing out slightly differently this time around. So what we're seeing is a little bit more strategic and an economic focus and perhaps the traditional expropriation we may have been familiar with in the past. What this boils down to is that governments are demanding more value from their resources. And they're doing this through perhaps demanding higher royalties or local content rules. But what is actually really interesting and increasingly popular is the sense of mandatory in country processing. And I think that that is really going to be critical in reshaping the resource nationalism conversation. And this is driven by the clear realization, and won't be new to anyone in the room, that simply exporting your raw commodities leaves countries vulnerable, and it misses the opportunities that lie for job creation, skills development, and of course, revenue generation, regardless of who ultimately owned those raw commodities at the beginning. So I wanted to actually just draw a parallel with what we're seeing in the mining sector relative to, and we can draw some takeaways for the oil and gas and hydrocarbon sector more broadly. But if we take Zimbabwe's lithium policy back in 2022, for those of you who aren't familiar with it, in 2022, the government put a flat ban on exporting raw lithium products from Zimbabwe, and it sort of forced investors to establish processing facilities domestically. This was hugely disruptive. It might still seem very disruptive to many people in the room. But what has been the impact of that? It has started to attract investment in value add infrastructure. So the desired effect is taking hold. And there are other examples that you can sort of draw on, specifically from the mining sector, and the parallels are telling. What this demonstrates is that when resource nationalism is driven towards value addition, it can be successful. Now, that's not to say it's not without risks. And you did mention West Africa, and I think it's fair to say that investors are going to see any sudden regulatory change as destabilizing. One way to put it, I've sort of seen in the media, is money flows to where it's welcome, and it will disappear in the blink of an eye. So, what does that mean when you're trying to understand the need for value addition, the need for governments to control more of the value of their resources, and this concepts around resource nationalism? It's going to boil down to African governments are going to need to balance asserting their sovereignty over their resources with maintaining a predictable and welcoming investment climate. So, looking ahead, how is this going to sort of manifest in the years to come? I see resource nationalism as evolving. It's becoming increasingly pragmatic, right? So governments have identified this need for value addition. They are going to require increased beneficiation. They are going to require increased local content. But also governments are going to recognize the capacity constraints that are there. So capacity constraints in energy, capacity constraints in infrastructure, and even in technical skills. Those gaps are there. So resource nationalism in that way is going to have to be phased. It can't be sweeping the rug from under us at all. And that means that it can be managed, so to speak, if it's being phased. And I think now is really the time for this, right? With the global energy transition, global technology demands, Africa really has the a point in time to make greater demands of investors. Supply side demand and price are equally important to buyers at the moment. And this gives Africa leverage in those negotiations. But I think the winners are really going to be the countries that design transparent, predictable frameworks and choose to partner with both investors, but also local communities in good faith. So I think if I were to sort of sum that up, resource nationalism is likely to continue, it is likely to intensify, but the impact of it actually depends on how it's being executed. So countries who are doing it well could effectively align local needs with foreign interests and use it as a catalyst for industrialization. And those who get it wrong are going to drive capital away, and it can actually serve as a deterrent for investment. So I think for the future of Africa's investment landscape, it's really going to be on striking that balance on the execution of what might be perceived as resource nationalism.
Thank you very much. And actually, I think within that, there's a really optimistic and positive message there, which is a great place to end this morning's panel. So all that's left for me to do is to thank the panelists very much for their contribution today, and a round of applause, please, for the fantastic contribution.